I'm really excited about this group of individuals you're about to hear from, so I'm going to go ahead and jump into introductions. First, we have Mike Sibley. Mike has over 20 years of experience as a certified public accountant and is the partner in charge of the firm's Daytona Beach office. He has served organizations representing various industries, including manufacturing, construction, and other commercial and professional enterprises, as well as governmental entities. Mike serves as an integral member of the firm's accounting and auditing team with an emphasis on audit and tax services. He also leads the firm's transition planning services team and the implementation of Lean Six Sigma practices within the firm to increase efficiency with their auditing process. And I don't think we actually said it, but the firm is James Moore. John Ferguson has served as president and chairman of the board of directors for Cobb Cole PA from 2010 through 2014. He joined the firm through the law clerk program in 1991 and has continuously practiced with Cobb Cole since that time. While Mr. Ferguson was born in Halifax Hospital in Daytona Beach, he grew up in Bradenton, Florida, and returned to the Halifax area after law school with his wife, Kelly. Mrs. Ferguson is a real estate agent with Adams Cameron Real Estate Company. Mr. Ferguson and his wife have 2 children and live in Ormond Beach. Mr. Ferguson also serves on the board of directors for the Florida Hospital Memorial Foundation. Mr. Ferguson practices in the areas of mergers and acquisitions, business organization and transactions, franchise law, commercial finance, international law, and general corporate and contract law. So welcome, John. And then we have Scott Bushkey, who you heard from before. Scott is the managing partner and founder of Cornerstone Business Services. With more than 20 years in the M&A industry, Scott is a recognized leader in the field, providing exit strategies, sell and buy side transitions, along with valuation services in the lower middle markets. Over the years, Scott has successfully executed hundreds of transactions domestically and internationally, working with private equity firms, family offices, and strategic buyers, both public and private. Scott's got the trust and respect of CPA and financial advisor alliances, investment banks, and other professional services firms around the M&A marketplace. So welcome back, Scott. I want to again thank you all for attending and remind you that our next webinar, our next day 2 of this series, is going to be July 14th. And it's going to include the following sessions: financial planning for business owners, valuing the business, so how to actually get the valuation that you're looking for, and tax planning and structuring the deal. Again, if you have any questions, go ahead and throw them in the chat box as we go through today. We will likely save those till the end, and then if we don't have time to answer any of your questions, we'll make sure to follow up with you via email. So with that being said, I think we're going to jump in. Again, this is common missteps in business transition. So John, I think we're going to start with you. As you know, oftentimes companies will wait until they've got that LOI or they're in the middle of due diligence to start talking about the skeletons in the closet, or they may not even know that they've got skeletons in the closet. So what are some things that a business can proactively do early on in the transition planning process to avoid missteps down that road?
Okay. Thank you, Heather, very much. I would probably categorize these in 3 general categories. First, it's your internal corporate documentation. Second, it's your financial, and Mike Sibley is very aware and keen on these issues, so I'll touch on those just only very briefly. And the third is your third-party requirements. So what I've seen over 25 years of doing this is, you're right. They come in, they're so happy, they have the letter of intent. Hopefully it's only a letter of intent, it's not an asset purchase agreement or stock purchase, but they get their letter of intent and I'm there, I'm selling my business. And so you go through, well, do you have your corporate records in place? Do you have your related agreements in place? They may own the real property separately from the business, but there's no lease in place. They may hold the intellectual property. And nowadays, so much of transactions are intellectual property based. So the trademarks and their patents and all can be one entity, and there's no agreements in place. And so if you reveal that you're not organized in this fashion, it turns off a lot of buyers, because some buyers say, hey, if you're this disorganized in protecting yourself, then what other hidden things are there in the company? And so before you even really go out to solicit buyers or even talk to anyone seriously, sitting down and having an internal look at yourself, your corporate records? Do you have all your written actions in place? Do you have your assignments of interest in place? If you have, did you offer options to employees? Are those still outstanding? We can do all those things easily behind the scenes. So then when we show the buyer, it's all nice and pretty. Financial, profit and loss statements and balance sheets. I was listening on the earlier presentations, and key. Obviously, you're not going to get any deal done if a buyer comes in and your financial statements and your balance sheets do not mirror what reality is. And so once again, if we have that realization in front of that buyer, the deal is done. There's not going to be the trust factor there in order for them to continue. And hopefully, in that case, it dies early in due diligence before you're too inconvenienced and spent too much money. And then you can hire Mike Sibley to make sure you get things in order. Mike and I have had 2 transactions where that's occurred. They came to us after the fact, and we tried what we could, but ultimately the deal died. Mike got everything in order, and then a year or 2 later, they got back in place, and everything worked out fine. The third is third-party stuff. Permits, licensing, key vendor agreements, key employee agreements. These are the things that drive value to your business. But as you get so busy doing your day-to-day, it is easy to, well, that contract expired. Well, that was oral. Well, we talked about that. Well, what are the terms? It's in the email somewhere. Once again, doing it up front, the buyer comes in and says, these guys have their act together, and the closing is more likely to proceed.
Good. So you touched on the importance of financials. Mike, this one's going to come to you. We know that accurate financial statements in the accounting process are really critical components when you're doing the due diligence. Talk to us about some of the steps that have occurred in your experience in that area and how the planning process can be used to improve this prior to the actual sale.
No, that's a great point. John brought up those 3 buckets are absolutely exactly where we go to. And so hitting a little bit more onto the financial side of things, I've seen deals, not only I've seen deals that have not got, they died, but I've also seen deals that went the better part of a year and then died. And then I've seen deals that went the better part of a deal before they finally got it done because we could get all the accounting and all that stuff caught up. And I can tell you a deal that goes the better part of a year and dies is extremely expensive for everybody. And that's not a good thing to be in. So the first thing on the financial side is we've got to get your financial house in order. And sometimes business owners are often surprised that what exactly that entails. So somebody might focus on, for example, right now, somebody might focus on 2020. Okay, we're going to focus on 2020. We got to try to make sure that's in order. Well, what we're really going to look at is what's your trailing 12 months. And I think Scott mentioned in the first session a trailing 12. Trailing 12 is the last 12 months. That means part of 2020 through, let's say, May of 2021. So you're June 1st through May of 2021. We're going to have those records in good order. We also want to make sure we have a good process for closing the books, because that's an important process. Heather, you mentioned one of the value drivers is good internal processes. We got to have a really good process about that. But it's not just 2020. It's not just the trailing 12 months. In due diligence, they're going to look about 3 years at a minimum on financials. I've seen some go back as much as 5, but really they're going to be looking at 3 years. And what are they looking for? They want to see trends. They want to see, is your revenue consistent? They want to see if all of a sudden you had some standard level of expenses and all of a sudden they dropped and your EBITDA, your net earnings go way up just 1 year. And why did that happen? Was something excluded? Things of that nature. Now, you don't necessarily, I've seen plenty of companies sell that were not audited or have reviewed financial statements, but you need to go through a deep analysis of your financials and say, is all of this in good order? And, let me give you a couple of quick examples of where, John alluded to a deal that, went off the rails. We got involved with a company where their inventory, none of their inventory ledgers, their subsidiary ledgers tied to their financial statements. And they had all these wacky adjustments in the prior 3 years. And the buyers came in and really wanted to buy the business. They were emotionally connected. And this one went on for the better part of a year. And ultimately, the LOI price was probably in the high 20s, and ultimately they got down to much lower in the teens because they just couldn't get comfortable. The deal died. Very expensive process. So immediately what we said is, let's get our hands around inventory. Let's get our hands around the consistency in the financial statements. And then in 3 years, we can go back out. Well, now we're looking to go back out. Everything's in good order. We had another situation where because the financial statements I was helping on the buy side went in and they were asking for a substantial purchase price. And the books and records, when you started getting through it, bank reconciliations didn't balance, the inventory records. And when we talk about inventory, it's not just about, okay, can we get a ledger that ties? How good is the inventory? Is it a bunch of old stuff that needs to be thrown away? So you got to really go through those and understand and be able to talk about, what makes sense in these financial statements, and can you give that comfort to them? And it's also, and it goes beyond financials, it's the operational and the financial controls. What story is the financials telling about your operations? That's what the buyers really want to dig into. So we spent a lot of time going through and making sure what I sometimes call a pre-due diligence, and making sure that we can make sense of the financials. They're in good order. We can explain everything. We've dealt with the risks in it. I saw on the buyer side where they sued the seller because of not disclosing warranty liability until the very end of the process. It was a very, very expensive process, and it did not go well. They ended up settling. And so that was a financial error that created just substantial issues. So there's a lot of issues that you have to go through to make sure so you don't make these missteps and you can make a smooth transition. And then finally, I'll just say budgeting is another aspect. If you can get good at budgeting, because one of the things buyers will want to see is, okay, if you have good control, but what are you expecting to do in the next year, 2 years, 3 years? What does that look like? So I can get some confidence that you're expecting to continue to sustain the same level of revenue, the same level of expenses. What's going on now? If you're expecting all of a sudden you have a customer that's 50% of your business and you lose that customer, well, that could create problems down the road. And that's something that, it's could have a significant impact, especially if you have earnouts and other things involved in the purchase price. So I know that's hitting a lot really in a short amount of time, but I'll summarize it by just saying you got to make sure your financial house is in order.
Yeah, and I think it is hitting a lot, but it points to the fact that there's a lot that goes into this. There's a lot of things to consider, and that's just one element of this. That's just the financial piece of this. So Scott, and looking at you in the process, when an organization gets to you, or where a business owner gets to you, talk to us about some of the experiences that you've had where companies have maybe made errors prior to getting to you, or they get to you and then you tell them what they need to do and maybe they don't follow the advice, and how has that gone?
Yeah, it usually doesn't go very well. So the one point that he just made is hiding issues. They don't tell us like, oh, hopefully Cornerstone will find this out or the buyer will find this out. Well, I can tell you the buyer will find it out. The amount of due diligence that's done by buyers these days in the aluminum market and above is very, very thorough. And we have a saying, go ugly early. The more you can, no business is perfect. So, hey, here's an issue that we have, but here's how we think you can resolve it. Here's the opportunity if you're good at this or whatever it might be. And that way buyers either will self-select out and you don't have to waste all your time with them if they're going to find it out at a later date. And quite honestly, when buyers are more competitive of trying to get the deal and it's early on, they'll look past a lot of those issues where if it's at the 11th hour, you're at the closing table and all of a sudden they find it out in diligence. Now it's like, okay, what else, Heather, haven't you told me? And do I want to trust Heather as my new partner going forward or taking over this company? So that's a big one. I think some of the other most common ones are, accepting talking to an unsolicited bid. Some big company or private equity firm knocks on the door and says, hey, we think you've got the best company in the world. We'll give you all kinds of money. Let's go for dinner. Let's get to know each other and don't worry, we'll take care of you. And the reason that they're spending all this time and all this money trying to find sellers that aren't in the market, because they know absolutely you will leave money on the table. You will get a worse structure than if you're in market and there's multiple offers and multiple buyers and bidding up and things like that. So if you think you're not going to leave money on the table, that's a big one. So we see people responding to unsolicited bids. So they'll come to us and say, well, yeah, I want to work with Cornerstone or any other M&A firm, but I want to vet out this one buyer first that called me. Well, again, you're going to tell them things, you're going to leave money on the table, and if they get the deal done, it's not going to go well for you. And a lot of times there's actually classes that these private equity firms and other big corporate developers take to basically steal private companies, tell you what you want to hear in this long drawn out process. They actually take courses at high level universities to know the psychological warfare basically of how to buy a privately held family owned business. The other one is setting an Ascii price. So again, a lot of times with these unsolicited bids, the first thing they're going to ask is, hey, just tell us what you need, because all you're doing is setting a ceiling. Or if you go out to your competitor, I'm just going to call my competitor down the street and see if they want to buy me. They can take out a competitor and all of those things. Well, survey after survey has shown for this, $5 to $50 million market size, that's on valuation size, 75% of the time the buyer's 100 or more miles away. So there's a chance that you might not know who the buyer is. In most cases, you might not know who the ultimate buyer is that you like best to buy your company. But to call the competitor down the street before they call an M&A firm just to save, 5% or whatever it might be on a deal, again, it's very, very risky, because they'll be, oh, sure, yeah, give me information, give me this, give me that, give me your financials. What are your margins? Product, margin by product line. Well, they're gaining all this intelligence. And at the end of the day, the odds of being successful aren't very good. A lot of times they'll put out a lowball offer or say, no, we just don't want to do it. But now they've got all this intel on you and your company that they didn't have before, and it's going to be unfair. They're going to have an unfair advantage going forward. So it's very, very, very risky. I think a lot of people think, well, I'm just going to talk to this one buyer, this one competitor, and if that doesn't work out, or these 5 competitors, and if that doesn't work out, then I'll go to an M&A firm. But, it's kind of like, well, there's no harm, no foul. Well, it's not like golf where you can just take a mulligan. You typically do damage. So if you're putting an asking price out there, which, again, is one of the big no-nos, you've just set the ceiling for your value of your company. And to give you an idea, we just took an engineering company to market, and we've been working with them for the last year and a half. And we thought we were going to get 7 to 10 million. We got 11 or 10th. They're probably going to sign next week at 17 million. So if someone would have came in at a low offer, they could have left $5-10 million on the table. And, you just don't know. And then lastly, I would say on this one is going with cheap advisors, or where most cases is going with an advisor that's a generalist. So this is, so kind of putting my doctor analogy, this is heart surgery. This is brain surgery. You're not going to go, so you've got your general doctor that you've had for 30 years that you do your annual physical. They know you better than anybody else, just like your attorney and CPA probably know you better than anybody else if they're generalists, but are they specialists? Some, like Mike, are. They're a big enough firm that they've got the specialist in, and some firms aren't, from a CPA tax standpoint, or definitely from an attorney standpoint. There's very few attorneys that truly specialize in M&A. They might say, it might be one of the 25 things they have on their website, but do they, how many deals have they truly done in the last month, last quarter? Because if you don't have that team of specialists, again, it's like having the guy that's done your physical. You say, oh yeah, I took a course on the brain, 20 years ago in college, and I saw a little bit of residency. Yeah, you know what? Let's give it a try and see what happens. But that's what people do day in and day out. Or lastly, they try to sell it themselves and save a couple percent, and don't need an M&A attorney, and don't need this. And I liken it to boxing. You can read every book, YouTube video, everything else on boxing, but at the end of the day, you go in, 0-0, and you're going up against a competitor that's 45-3. How do you think that's going to turn out? And just like boxing, that's usually how the deals turn out in M&A as well, because these corporate development teams have people that are very, very skilled, and this is all that they do, are private equity firms and family offices. They get out of bed every day to do one thing: buy companies for the lowest price, and knowing how to get them at the lowest price. So those are some of the things of just, I think early on, the biggest thing I see now, just because there's so much money out there and so many buyers, is responding to unsolicited bids and not getting any other competition to the table. We've done that before, where there's an unsolicited bid at $5.5 million, and we were able in 60 days to bring out a couple other competitors very quickly, still keep the buyer at the table, still keep everything confidential. and ended up closing the deal 60 days later for $6.75 million. It had a much better structure, much better cultural fit, and everything else. So those are some of the different things that I see that, where people make a lot of mistakes up front.
Yeah, and Scott, I'll say that when my partner and I were looking at selling our business, we started initially we started looking at doing it ourselves, and we talked to a couple of potential buyers. And when we shifted over to, so we thought we had an idea of what we were selling for, and when we started talking to the M&A company we ended up working with, we I want to say we more than tripled the rate of the highest offer previously. So it does make a difference having the right people involved. We talked a little bit about LOIs a lot, but we haven't really talked about what an LOI is. So John, we know that that's an important document. Tell us a little bit about what that is, what the process of an LOI is, and some things to look out for when you're going through that piece.
Okay, all right, will do. When Mike was talking, he mentioned a war story about getting near the end, before the asset purchase agreement was signed, before closing, then a material fact was disclosed and the buyer sued. Well, I raise that because most people think, oh, letter of intent, it's non-binding, I can sign it. I've had people come to me, well, I signed a letter of intent 2 months ago and we're getting ready to negotiate the asset purchase agreement. And so I've walked through with them what I'm going to say now. There are provisions in a letter of intent, an LOI, that are binding. Even if the letter of intent is titled non-binding letter of intent, if there are provisions in the body that say the buyer shall do this or the seller shall do this, that is a binding obligation. So number one rule, have an attorney, have an advisor, have someone who, to Scott's point, someone who does this for a living, have them review a letter of intent before you sign it. Now, typically, most letter of intents have binding and non-binding provisions in them. And if they're drafted by an attorney, we try to draft them such that we clearly articulate which ones are binding and which ones are not. Oftentimes, the non-binding sections lay out the deal points. What they're going to buy, what they're going to assume, what they're going to pay. There's always going to be wiggle room because this is before due diligence, and so and there's an inherent obligation that the parties are going to negotiate from those non-binding provisions in good faith. And so that goes back to Mike's point, where if the seller knew of a material point that they intentionally withheld, that's not negotiating in good faith. So even though those terms are non-binding, the inherent obligation was, well, you lied to me. I would not have incurred $100,000 in due diligence, so therefore I'm going to sue you to recover those damages. On the binding side, there are some very important things that everyone should always consider. One is confidentiality. Hopefully, prior to signing the letter of intent, you have a separate confidentiality non-disclosure agreement. You are going, even the fact that you are talking to them about selling your business in and of itself may be a materially confidential issue. You may not want your employees, you may not want your vendors, you may not want your customers to know that you are considering selling, because they may say, oh, well, I always deal with Joe and Joe's selling the company. I'd rather go down the street rather than whoever he gives me. And this deal may not go through. And then to Mike's earlier point on the first session, if all of a sudden your business starts going down because all your customers say, oh, they're selling, now the last 12 months trailing revenue figures are a lot lower, your purchase price is going to be lower. So confidentiality, probably one of the biggest things to do, either in the letter of intent, preferably in a separate agreement. Exclusivity, another binding provision. Before a buyer is going to spend thousands and thousands of dollars in man hours investigating your company to see if it's worth what they're willing to pay for it, they're going to want to make sure that you're not going to go off and start negotiating with someone else. Completely reasonable. I represent buyers and sellers. That's what I do. It's completely reasonable that the buyer does not want to do that. So they'll say, you know what, I want to tie you up. I want to make sure that if you get any offers, you can't pursue them. Some buyers want you to disclose those offers to them. Obviously, when I represent the buyer, I always try for that. When I represent the seller, I try to argue against that. But exclusivity is important because it also ties into the length of the due diligence. And so, you need to tie in and say, no, we're going to give you exclusivity for 2 months. Depending upon what size your business, however many moving parts, maybe it's 30 days, maybe it's 90 days. But you want to tie them into a binding due diligence period because you're only willing to give them exclusivity for a short period of time. And then you also want to tie them into say, what, we're going to have our first draft of the definitive agreement, whether it's a merger document, whether it's a purchase of stock, a purchase of assets. You want to have a time frame because due diligence could last forever. And if you don't want that, you're giving up opportunities to sell to other people. So in the letter of intent and the binding provisions, you want to make sure that, hey, by July 1st, I want to have the first draft of the purchase agreement so that you at least get down the road. Another thing that people always want to ask me about is deposits. A seller says, "No, what? I'm taking my company off the market for 2 months. I want a non-binding deposit." We can ask for that. I'm here to tell you that's rare because most buyers consider the amount of time and money that they're spending on due diligence as their good faith. So non-refundable deposits are rare, and I'll tell my clients that, but we can still try and push for them. It depends upon leverage. I think those are the things I jotted down as I was talking.
Yeah, there's just so many variables, particularly around the LOIs, and they are tricky. And I remember having, several of those documents coming in and just not knowing what exactly I should be doing with all that. So thank you. Taxes, always a challenge. Mike, I've heard you talk before about that, state and local tax, and how they can really impact the outcome of a sale. Can you talk to us a little bit about what you've seen there and how the planning process can help with that?
Sure, and this is one of those scary areas to me that can pop up out of nowhere, especially if it's a company I haven't been working with for very long. Let's assume we've gotten our financial statements in order, everything's in good shape, we're moving along that route, and now we're in due diligence, and in the due diligence process, they start talking about what we refer to as SALT, state and local taxes. And, companies can get themselves, maybe not even be aware that there are risks around these taxes. And let's talk about sales taxes first. Sales tax is one of those taxes that whether you have a stock deal or an asset deal can carry over. So even an asset deal, you can carry the sales tax liability will carry over to the buyers. And that's a scary situation for a buyer. That's a risk standpoint. So they're going to spend some time asking about, what's your process for collecting and remitting sales taxes? How are you dealing with other states? And in some cases, businesses may not even realize they may have a substantial sales tax liability to other states. There's been laws in court judgments recently, and next thing you know, you should be filing and are collecting and remitting to another state. Even in the state of Florida, there's a lot of different sales taxes and then sales tax exemptions. And are you part of it or are you not? So sales tax is something that in part of the planning process, we really need to look at how do you operate? How do you sell? Where do you sell? Are you an online retailer? Are you, do you have retail store? How are you shipping your products to the different places? So there's all sorts of things that we need to look at to make sure we understand what that sales tax risk is. On the other hand, we have state income taxes. In Florida, hey, we're lucky if you're not a C corporation, so if you're an S corp, an LLC, you're not paying state income taxes, so you're not thinking about state income taxes. But other states have state income taxes. In fact, some of them have gotten really smart and said, we're not doing income taxes, we're going to do franchise taxes. So if you're doing business in a certain way in certain states, you may owe taxes there and not even know it. I was just meeting with a new client the other day, and we were just talking just generally about his business operations. He made one key change and didn't realize this, but he's now subjected himself to state income taxes based on this one change. And so we're going to have to make sure we're capturing that. So we're doing a SALT assessment on his overall operations to make sure. You get into, say, you're a manufacturer. Well, manufacturer, if you're buying materials for part of the manufacturing process, so in other words, you're manufacturing it, you don't pay sales tax. But if it's supplies or consumables, you have a sale or use tax that you should be paying. Sometimes that doesn't always get caught in the accounting process and pay. So there's a significant amount of risk that can be that can come out there. And we talked earlier, John hit on, these liability issues, and it's definitely an uncomfortable situation when oftentimes, I've been on the sell side, and you got these people who are experts in sales taxes only. They're on the due diligence call, and that's the only thing they do with their career right now is sales tax, understanding laws around sales tax. So they're going to know exactly if there's a problem. The same thing on the state income tax side of things. Usually the federal taxes are pretty straightforward at that point, but it's really key to understand what are you doing, where are you selling, the operations, and to go through that analysis. Because if we've got time to be able to fix the issue and get the issue corrected, then we've got a good document, a good trail that we can show a buyer down the road. Hey, we're good. Here's our sales tax filing. Here's our process for understanding sales tax. And here's how we're going to make sure that, this is how we make sure that we're good going forward, so we don't drop into this potential. And I think John mentioned it earlier. The due diligence process, they're going to find stuff. They're going, if there's a problem, they're going to dig it out. They go through pages and pages and pages of questionnaires and document gathering, and it's an intense process, but the preparation can have you nail that process without a problem. Or if you're waiting and all of a sudden you're in it now, it can show where the problems really are. And I think, when you get these LOIs, you'll often see, hey, we want to close in 60 days or 90 days or whatever it might be. These guys want to come in, they want to do their job. They're going to come in. It's going to be very, very fast. It's going to be heavy. It's going to be a lot of time during that time frame, and they want to get the deal done. And so you really have, and that's good because it keeps costs down, it keeps your costs down. But if you're not prepared, it's going to delay it and ultimately potentially even kill the deal. So it's a critical area, and I've seen it so many times where there's been problems in that area.
Yeah, and sales tax in particular can sneak up on you. Speaking from experience.
That's for sure.
So a lot of times, and I've seen this in the work that I've been doing with Velocity too. Business owners, we kind of get maybe fixate a little bit on what we think the outcome is that we want. We may not have all of the information, but we think that we have an idea of where we want to go. Scott, in terms of exit paths, have you seen owners just get too fixated on one path to the detriment of really maximizing the sale value that they can get from the deal?
Yeah, I do, and I think it's somewhat getting fixated on kind of what the transition is going to look like if they've even thought about it, and the other is just probably as much is just getting comfortable in the business. You buy a company or take over a family business, and you build it up, or you got a debt, you got to pay down the debt, so everybody's focused, and then all of a sudden 5-10 years later, there's no bank debt, you've got money in the bank, life is pretty good, and all of a sudden you kind of get more into a lifestyle business, and you don't keep pushing, keep setting strategic plans into what you mentioned in the first session, knowing where you're going to go, what does that end goal look like. But I think a lot of people start out idealistically, and that's not wrong at all, but it's I'm going to give it to my children, and what we find out in a lot of cases that they never even had a conversation with their children. The children works in a child or children work in the business, and they just feel like they're just going to take it over. But maybe that son or daughter doesn't want to take it over, or maybe they don't really, they really should. Not everybody's wired to be an entrepreneur and have that kind of passion and energy and just know-how. So, for instance, I had a client that we were going to sell his business, and he was just devastated because we talked about what he had done prior. He's like, oh yeah, I was going to give it to my son. He's been in the business for 15 years, and found out that he didn't want it. He couldn't believe it. And what he found out is that his son talked about, like, Dad, you bought this lake home 2 years ago. It's awesome. He goes, oh yeah, it's amazing. The business was able to afford that. He goes, yeah. He goes, how many times were you up there? He's like, well, 5. He's like, well, how many times did you stay the whole weekend? Well, probably 2 or 3. Because I've been up there every weekend all summer long, with my family and my kids, and why would I want to give that up? And so he's like, I'm happy just being an employee. I'll keep working for whoever buys the company. So he didn't build a company in order to sell it. He just built it to transition it, and it should be the same, but it's a little bit differently. So thinking strategically of, what types of buyers would want to buy my company, and all the things that you guys have talked about of building out that management team and customer concentration and everything else, versus just, oh, I'll just give it to my kid and, they'll pay me out over the next 7 to 10 years or, whatever it might be. So I think those are some of the bigger things. It's just, having that conversation with your son or daughter or children earlier rather than later, because you might find out they're not in business and they really want to be, or vice versa, they're in it and they don't want to be in it. And then also understanding, what's fair, if 2 kids are in the business and one isn't, how do you split up your wealth that way, and making sure that, things stay happy in the family. Because I've seen too many times where all of a sudden, sometimes it's a lot of money, sometimes it's not that much money at all. The families get sideways and son or daughter retaliate against mom or dad, with holding the grandkids kind of hostage. And all of a sudden now grandma and grandpa don't see the grandkids for Christmas and Thanksgiving, and it just blows up the whole family. So making sure that those things are in place, you have the talk, and truly what you want out of the sale. I think too many sellers think about money and value, but what are all the other things that you want out of a sale? Because they might think they want to sell it to a third party, but when you look at what the terms of the deal they want, it would be much better to have their management team buy them out over a period of time or whatever it may be. So I think it all goes back to, what do I truly want out of my business? And we've got surveys and things like that, assessments that we can have folks take, or we do have folks take, to really truly understand what's most important to me. And the good news, there's no right or wrong answer. It's just whatever makes the most sense to that business owner, and then working towards that goal on a proactive basis with the team versus just reactive. Because again, as we mentioned before, too many people just wake up one day and it's not fun anymore. In fact, we've done a national survey on a quarterly basis since 2012, and almost every single time the second leading cause of why they went to market is they're burnt out. And think about anything that you do well when you're burnt out, especially the largest transaction of your life, versus planning, having a program, knowing what you need out of the business, and then moving forward, with an initiative, versus just waking up one day and knowing it's not fun anymore.
Yeah, absolutely. And Scott, you actually teed me up perfectly for my next question to John, because a lot of times we are dealing with family transfers or employee buyouts, and you've touched a little bit on some of the logistical issues that can pop up around that. John, can you talk to us a bit about some of the legal issues that might come up in a family transition or an employee buyout?
Yes, definitely. And I would reiterate everything Scott said. I mean, Scott was going through, I'm just shaking my head. Yep. Had that happen. So Scott, you're spot on. Before I go into a little bit more detail on that, there's one point there's an overarching point that I have not mentioned yet, and I've seen this happen a couple times. And something Mike said in his last comments sparked it. He was saying about how in depth the due diligence period can be. Now, many times the seller, you're engrossed in your business. Your business is operating, it's humming along, but it's humming along because you're focused, and all your attention is focused on doing what you do every day, making money. Sometimes when you then shift mentally in your brain to sales mode, and also you start doing all the things that Mike and Scott and I are talking about, getting ready for the sale, and then handling the due diligence, all of a sudden you take your eye off the ball. And one of the hardest things for a closely held corporate owner to do is to continue running his business or her business while trying to sell his or her business. And sometimes that will require, there's only so much your accountant, your attorney, your broker, your advisor can do. I mean, sometimes you might just have to work extra hours, or you might have to hire some people. So I just want to put that out there, that I've seen many a deal fail, and then they get back into the business, and it's 2 or 3 years before they're able to retrack whether it's decreasing the expenses or increasing the revenue. So I would just caution in this introductory stage to keep that in mind and plan accordingly.
Yeah.
Legal issues when selling to family and or management team. Oftentimes when you sell to family and or management team, you will end up having to hold paper. Sometimes they would be able to go to a lender, third-party lender, and get the funds and pay you cash at closing. I'm here to tell you that is the super rare exception. So what that means is you now become a creditor. You become a creditor of your child, your grandchild, your manager for 20 years, the people you love, the people you trust, the people you've gone to battle with. And that's hard. And, in the earlier session, you guys talked about a lot of times, you need, the seller of the business needs this money in order to retire in the manner they want to. And so while sometimes it is happier, feels good to know that your legacy is continuing on because the manager, the kids, and that's great. And that is a true, as one good reason to sell to this group. But you have to counterbalance that with, I still need to get paid. And I need to make sure that if I have to take back the company as the creditor, because I'm not getting paid, and me and my spouse can't live the life we're living, that when you step back in, the company is still relatively close to what it was when you sold it. What you can't do is to keep giving Junior extensions, and all of a sudden it's 3 years later, and you step back in, and there's nothing left. Not even you can salvage it. And now you've worked your entire life, and it's not maybe it's not Junior's fault. Maybe there was a sick family member, or maybe the economy turned down. It's not a matter of blame, but it's a matter of you treating yourself as, hey, I need to treat myself just like a bank would treat me if they were loaning money to me. And that means you need covenants and access and control until at least the majority of the money is paid, or until you're certain that they're able to do what they're able to do. So that's either a management team or a child. From an operations perspective, what I also recommend people, when we set out ahead of time that we're going to do a business succession plan with your management team, is set out a goal of, within X number of years, I'm going to start working 3 weeks a month and just be gone.
Mm-hmm.
And yes, they can do damage in that 1 week. Not a lot that you can't fix.
Right.
And then maybe it's two, maybe it's half the time, and you sort of ease into that the whole time, letting them know that, hey, we're going to have an agreement in place. This is my business succession plan, and so they understand why they are taking on more responsibility, and you can get some comfort level that the manager is able to handle it. And then the harder one is with children. We all have a blind spot for our children. And so my recommendation when someone wants to pass that on and they're going to be holding paper is, I recommend that you get a coach, someone who can come in and analyze what that child is doing. Does the child have the aptitude to lead the company when you're not there? Leading the company while you're there is one thing. Leading the company when you're not there is another. So I think at that time, it's well worth the money to have a coach or someone come in to give that impartial advice.
Yeah, I think I second all of that. And I think that the business owners across the board, like if you're considering anything like that, like transitioning over to a manager or key employee or a family member, again, really looking at what you have to look at it objectively and pull your head up and say, okay, what does the organization need moving forward? And if you are dead set on this is the person, invest in developing them so that they can handle it. Really critical. Thank you. So Mike, talk to us a little bit about working capital and debt and how that can impact the sale and what you can do early on, maybe significant time in advance to really prepare for that.
Yeah, sure. And I think actually I want to jump back to the family side of things, because I do think this will play into that concept of working capital and debt a little bit. But when you're going down the road of selling to a child, selling to a management team, it is a little bit of a different process in terms of how you're looking at things. I still think it's important to look at what's the value of the business. What do you need to retire on? Are you depending on this? And Scott mentioned earlier, and he's exactly right. When you sell to a third party, 80-90% of the sell price you get on time of closing. And so your risk is at least mitigated. With family members, we often see, or management teams, we see, okay, we're going to have 5, 7, 10-year note, and then we might be pushing. We might have to make an acceptance. Allow them to defer a little bit because they're having a rough patch, and so you got a lot of risk tied up in that. And I have actually seen businesses have to take over. Or parents come back and take over businesses again. So, so you definitely have some things to deal with there that can be a concern from a risk standpoint. Now, where that jumps into working capital is, how are you structured currently? So if you're handing your business over to the kids to run, if you're highly leveraged, that can be very difficult from a cash flow standpoint. But let's just talk about what working capital is first and foremost. Working capital in just a generic accounting sense is your current assets, like your cash, your receivables, your inventory, less your current liabilities, which is your accounts payable, those term payables, your current portion of long-term debt, any accrued expenses. That net amount is really your working capital. So that's an important concept, because your working capital is actually what allows you to fund growth, allows you to keep the business moving. Oftentimes, businesses will have lines of credit. They'll have, long-term debt, short-term debt payments, things of that nature. So your working capital is really critical to understand, so you can see where it is and where you're going with it, to make sure that you can continue to fund those operations. Okay. Now, from a buyer's standpoint, this is one of the things they're going to look at is, what is your working capital? What is your historical working capital? Because in a purchase agreement, they're going to come back and say, hey, when we buy this company, we expect you to have net working capital of X amount. Now, where do they come up with this amount? Well, this is where it can get problematic. I had a client that in the purchase agreement, as part of it, they came up with this huge working capital number. And they did it based on the buyer's projection of what they think working capital is going to be over the next year or so, based on how they're going to run the business. Absolutely bad deal. Fortunately, that didn't. We went back and we said, okay, the trailing 12 months of working capital said they had about $100,000 of working capital, not $400,000. So that needs to be in the deal. That's what you're going to leave in the business. That means your receivables, less your payables, and pretty much most times you're not going to leave cash in the business. The cash is there, you're going to pull it out beforehand. But what happens with this working capital is they say, okay, if your working capital isn't $100,000, say it's only $70,000 on the date that we close, and historically it's been 100, we're going to reduce your purchase price by $30,000. This is a trick. This is not a trick. This is what happens in most purchase agreements, but you got to understand what that means. Now, if let's say it comes in at $120,000, you're going to get a $20,000 increase on that. So working capital is really, really critical to understand how it works, how collections work, but it's also understanding what those components are. When I talk about receivables and payables, I had another purchase agreement one time come through from the buyer. They said, hey, we're going to take the receivables, but you're going to owe all the payables. And that is a really bad deal. You never do something like that. And fortunately, between the attorney and I, we both scratched that out before it showed up 3 more times in subsequent purchase agreements. And finally, the owner said, after we advised them, the owner said, listen, if this shows up in the next draft, the deal is done right now, because we're not playing these kind of games. So working capital is really critical. It's critical to just know from a business standpoint anyway, because you want to make sure your cash management is strong, how you're leveraging your payables, how your collections are, what are your credit policies on collections, how are you monitoring that, how do you manage that? You manage really good working capital, and that provides good working capital for growth. One of the things we want to do out of this transition planning process is allow for more value in the business. The other piece, just to hit real quick, is we talked about debt. In the first session, we talked about cash-free, debt-free deals. Most deals, you got a purchase price. You might pay some closing costs, some commissions, things like that, legal fees, accounting fees, whatever it might be. And then you're going to, most cases, have to pay off the existing debt that's on the books. You might owe for some equipment you purchased in the past. You might owe on a building. You might owe on a line of credit that you were using. All that's going to be the net proceeds. So one of the things we want to think about in this transition process is, what is that net after debt going to look like? And then can we manage our cash flows? Can we manage our business to try to reduce some of that debt out of the current operating cash flows so you can get more net purchase price at the end of the day? Why are you highly leveraged? What can we do to decrease that leverage? How can we talk about that to make sure that we're maximizing your ability to get that purchase price at the end of the day? But we really got to look at your credit policies, your payables policies. Heck, even using, credit cards is becoming more and more the common way to pay, to get your extension on payables and really look at get that cash in the door. So there's a lot of things that we want to plan for down that road. And it's a critical piece of the transition planning process.
Yeah, just a ton there. I think, again, it points to the need for having the right people involved and really starting early to just kind of map out how, and again, building that infrastructure so you have good policies and processes in early on to really help mitigate a lot of that. And I think it's, all of this that we've talked about, the legal aspects, the financial aspects, on the business side and then on the personal side, business owners are navigating all of this, and they're navigating just this huge amount of change and emotion that comes with leaving something that you've often spent 30 plus years building, right? So there's a lot in there. These can become very emotional situations. Scott, talk to us a little bit about what you've seen around that piece, this being an emotional process, and how can that get in the way for business owners and impact a sale?
Yeah, so I think the emotional side, I think most business owners really don't know how emotional it's going to be, but at the end of the day, most of our clients we talk reviews, it's almost like giving up one of their kids for adoption, and it's not an easy thing. And I think the things that you see that can go wrong is we've had clients that will spend all the time and energy, hiring us, hiring attorneys and everybody else, doing all the work and literally getting to the deal. Where we had one client where they were in their 80s, and we were supposed to get 23.5 was the benchmark. We had 4 buyers between 24 and 26, and we're still negotiating up, and they just pulled the plug. And they had a lot of several $100,000s into the whole process, and just knew it and walked away. So it's a distraction. It's gonna it is an investment. It does take time and money to sell your business. So you want to make sure that you're emotionally ready and you don't pull the plug at the end. And the reason that most people do that is they know that they don't want to be the business owner anymore, or all the stress that comes with being the business owner, but they don't know, and I think it was mentioned before, they don't know where they're going to go. They don't know what's next. So, understanding what is next in your life, where am I going to take all this energy and all this passion? Where am I going to take it? And what am I going to put it into? Is it my kids? Is it my grandkids? Traveling, business, could be anything. But that's where you need to, again, by planning early, you can start to think about that and try out different things and see what you like and what you don't like. Again, with that passion and that emotion comes overvaluing a business, and you don't want to be surprised on what the market truly bears if you haven't done some of this work up front. We kind of call that the proud parent syndrome. Again, everybody has, as you mentioned, kind of blind spots with their kids, and they got blind spots in the business because this is something that you built. But I think that's the biggest thing is just understanding where you're going to go. Make sure you talk to the family, make sure they're emotionally and ready to go and on board, and your spouse or other partners are on board, and then just making sure that you think through it early enough so you're not just thrown into it. Because again, think about if you're burnt out and you're emotionally charged, and now you're going to try to go through this process, it's just not going to go well, and the buyer's going to see the stress on your face and know that they can get a much better price than what they were going to pay if you would have really been excited about sticking around for a bit, or kind of just how we can interact in that process.
Yeah, I'll say
I could go on, but I know we're running late, so I'll stop it there.
I'll say that it, again, having gone through this, it is an emotional process. And I had, my partner and I had started talking about selling a long time prior to us actually following through on the sale. And part of the reason that it took us so long is because we weren't at that time pulling in the right people to help, and we were trying to navigate it by ourselves, and we just didn't even know really what questions to ask. So it was very confusing. And to your point, Scott, about needing to know what comes next for you, that really was a critical piece for me. And it was when I was suddenly realized, oh, I'm going to have a baby. So that really focused me in pretty quickly and helped me prioritize and figure out what I needed to do. But it really took having something to focus on after the fact. Like, this is what I'm moving towards, that helped drive me to start putting the pieces together to make that happen. So I do think so much of it, and I've seen that in my work with Velocity too, like really getting business owners, and it's a struggle. It's a struggle sometimes, but getting them to really focus on, okay, this is not going to go on forever. I can either be proactive and plan out what this is going to look like for me to the best of my abilities, or I can just ride the current and potentially lose a lot of what I've worked for. So I think that's an excellent point there. Thank you, Scott. So we do have a couple of questions. I'm just going to throw them out there really quickly if we can keep you on all for just a minute more. One of the questions is really, so it's a business owner who's looking at transitioning over to their son, and they are, make sure I've got this right. They've got a strong management team in place that they think is going to be really be able to be supportive and helpful. But this could change, and so just getting an idea of what maybe the most recommended buyout method is, and what that looks like. I think that's a big question. So, are there, and anybody can speak to this, what are some of what's the best recommended buyout method for maybe a company that's transitioning over to a family member or an employee?
I'm just going to chime in real quick, Heather. I think a lot of this goes back to the financial planning needs of the family, what they're going to need, in terms of their personal needs going forward. But there's a lot of strategies with gifting, with, self-canceling notes to kids. There's a lot of different strategies to do this. But it really goes back to understanding their own financial needs on the front end, what their income and expenses needs might be. And again, that also the emotional and dynamic aspects of the transition itself. Is this the right transition?
Yeah, I think I'll go ahead, John.
Go ahead, Mike.
Go ahead. No, you go ahead, John.
Okay. I'm going to take a slightly different slant and focus on the managers, because it sounds from the question like the managers are a key component of the success of the child. So Jeff is right on structuring the deal, but you still want to make sure that those managers are properly incentivized to stick around with whoever is going to be the succession plan. There could be some hurt feelings from those managers that they feel passed over, or they don't quite have the respect for the child. So you can do that through a number of ways. There's some incentive plans that you can put in place where they stay for a certain period of time. There's a bonus at the end, or their bonus is tied to the profitability of the company, or whatever metrics are necessary in order to drive that manager to have a common success with the child, and hopefully that'll bridge you leaving and the child stepping in.
Well, it's also possible that maybe a small portion of the company become owners in, and doesn't necessarily mean 100% has to go. So you keep them tied in from an equity standpoint. I do agree with Jeff in terms of also understanding what are the financial dynamics of the parents. And to John and Heather's point earlier, is the son capable of running the company and wanting to? Yes, the business could likely cash flow, but let's really model that cash flow out and say, okay, based on what we know today, how much of a burden will that cash flow be on them? Will it manage? What happens if there's bad times? Go back to some cyclical times and say, if there's bad times, can it still manage? Obviously this is a little bit of a higher risk when you take on a note that could be a little bit longer in term. Could it be shorter term? It depends on what the cash flow. So you really got to look at, and I would say model that out and see what makes the most sense. You could do a combination of some gifting with a buyout, depending on the financial situation that you're in and what the purchase price could be.
Scott, you want to add anything? I'll take that as a no. So the last comment we had was, again, it's a family-owned kind of situation, 2 sons, 1 in and 1 out of the business, and just wanting some guidance around that. And I think, I think, again, I'm surprised. I don't know if anybody's actually said this on the call, but situations like this, remembering that fair isn't always equal, keeping that in mind and really looking at what makes the most sense, again, for the organization, who's put in the time into the business and demonstrated that they want it, and that they're capable of doing it. I think also, again, who's willing to step up and really take the time to develop and learn the skills that they need to run the organization moving forward. So some of those are some of the big things that I see. And it's really about mapping out who is the right successor for the organization, and taking the time to really develop that person. So anybody want to add anything to that piece?
I might just add real quick. It may depend, are you planning on gifting the business to the son, or is that son also going to buy you out? Because then they're really earning that business at that point, right? The other thing I've seen, and we're working on this just now, where we've got a family that's one of the parents is exiting, and now you've got other children who are not in, and they're looking at some other products, some life insurance that may ultimately go to the kids as a equalization of the benefit of giving the business, or setting some money aside to make everybody feel good. There's different ways that you can go through to try to make kids feel good about the process, but ultimately, obviously, you got to do what's best for the business. And if one of them is really taking it over, and so there's more discussion that needs to happen on that subject to really vet that piece out.
I would just add that in my experience, all along the way, having family meetings, discussing the finances, discussing the long-term needs and goals of the parents in this case, and getting the input of the family in terms of what their goals and needs are, can help drive what might be the right solution. Too often times do I see.
I think Jeff might have froze up there.
Yep, Jeff froze, and we lost Scott. So I knew that was happening.
I'll jump in for Jeff, because Heather, you're right. Equal is not necessarily fair, and along the lines of something that Mike said also, that you can treat the kids or the family members can wear 2 hats. They may get an interest as a kid, regardless of work, but the kid, if a child has been working in the business, has earned it as an employee, well, then there's a way you can provide more ownership to them. And then my caution is we lay out how are decisions made in the future, because the one who's running the business should not be hamstrung by somebody who's not in the business, but the one who's not in the business need to be protected from the one in the business taking all the profits through nice cars and high salary and bonuses. So it's really a balancing act, and I'm working through 2 of those right now. They're tricky, and to Jeff's point, communication is key.
Yeah, communication is key. I think also for any family business, having clear governance is really important. Like how are we? What are our agreements on how this organization is going to be run, how decisions are going to be made, and who's responsible for what? Very important. So, okay, I think our panels are starting to drop. Panelists are starting to drop off, so probably a sign for us to wrap this up.